Hello everyone, thank you for joining me. The global financial markets are crashing. While a major correction was certainly expected, as the Bank of Japan recently began to increase interest rates, and I will explain why that matters in just a minute, the complete tailspin still took everyone by surprise. The Federal Reserve and global central banks have spent several years now playing with fire by keeping interest rates artificially low, while building this truly massive wall of debt, a bubble. Now that it is clear that a strong earthquake is about to hit, that sandcastle is collapsing. Japan's Nikkei saw the biggest single-day tumble since the 1987 crash. It dropped 12.4% early Monday morning on the news of much worse than expected economic data from the United States. There was a flashing red sign that a massive economic downturn is just around the corner. And so as investors began selling equities to cut their losses, the Nikkei panic sell-off was so intense that a circuit breaker was triggered to halt it. By the way, since mid-July, total market cap losses are in excess of $5 trillion with a T, trillion dollars. In the United States on Monday, the Dow Jones Industrial Average crashed above 1,000 points, or 2.7%, by mid-morning. Additionally, S&P dropped 3.1% and Nasdaq erased 3.6%. The S&P 500 erased nearly $2.1 trillion of market cap. Crypto market crashed nearly 17%, with Bitcoin dipping well below $50,000. The dramatic drop in Bitcoin, by the way, screams loud and clear, in my personal opinion, that Bitcoin can never become a true safe haven asset, or a reserve asset, if you will, due to its extreme volatility. The dramatic bloodbath and the bear market are now causing fears of a severe global crisis, of a severe global recession. Coupled with the increasing uncertainty of what the next several days may bring in the Middle East, think crude oil here and commodities, is a perfect storm that can very quickly upend the already fragile and further weakening U.S. economy, with very serious risks to bank liquidity. In other words, this is just the beginning. So, how did this bloodbath begin? Let's take a look at it in very, very simple terms. At the most recent meeting, the Bank of Japan made a decision to end the negative rate policy and to increase interest rates by 1/4 point. While this may not sound like a big deal to many of us in the United States, but here's why it was a very important event. First of all, this was the second rate hike in Japan since 2007. For over a decade, traders used artificially low interest rates in Japan to borrow yen and then use that borrowed money, that borrowed yen, to purchase US dollars or euros. So in that transaction, the Japanese yen was used as leverage thanks to extremely low rates set by the Bank of Japan. This pattern is known as the yen carry trade. The Bank of Japan kept rates very low, while the Federal Reserve started to raise rates in March of 2022 and continued to hike rates through mid-2023. As they did that, the spread between interest rates enabled the yen carry trade to bring substantial profits to investors via these margin loans. However, nothing lasts forever, we know that very well. The central bank in the EU and the Federal Reserve here in the US are now on track to cut rates, while the Bank of Japan increased its rate by 1/4 point. This resulted in an unwinding of the yen carry positions. So what do we have now? The yen has been growing stronger against the dollar, which brings an end to margin loans. As margin loans are no longer profitable and they're called, the carry trade is unwinding and equity markets around the world are crashing. That is what's happening in a nutshell. But make no mistake, this isn't a routine event. It has extreme economic implications. First of all, we have to understand that the United States economy is very much important on the global scale. The most recent July labor report that I discussed yesterday was an extremely concerning indicator that those of us in the United States are about to experience a massive economic slowdown. Not a recession, a much worse event than that, given that the labor market data has been as unreliable as it can be. We don't know the real numbers, as prior months are revised down routinely. It has become a norm to revise down economic data. Full-time employment is dropping as the number of part-time jobs surges. Delinquency rates are up across the board. Take vehicle loans, credit card loans, and other consumer-type lending products. They show considerable weakness now. The most recent reports show that car repossessions are surging 23% as more and more Americans are falling behind on monthly car payments. Vehicle seizures are typically triggered after 3 months of missed car payments, by the way. So far in 2024, repos are up 23% compared with the same period last year. By the way, I did upload a quick video yesterday with further details on the recent labor reports, if you would like to get more context on that. Now, the banks in the United States are increasing their reserves. They're doing this because they now carry a significant amount of bad debt on their books. Consumer debt, as well as commercial real estate loans with underlying collateral, commercial buildings, sitting at best half vacant, if not completely vacant. In other words, that collateral isn't worth as much as needed to secure the loans. In total, there's more than $1 trillion in commercial real estate loans that will come due over the next 2 years. So that is another factor to consider when understanding the scale of this economic crisis. Following the global market crash this morning, prediction markets are now indicating that recession odds in the United States have nearly doubled overnight to 26%. If you watched my video yesterday, you may recall that last week, Goldman raised their expectation of a recession from 15% to 25%. The bubble is about to burst. Federal debt is growing at 3 times the rate of GDP. U.S. national debt increased by $120 billion in 3 days, so we're reaching $36 trillion in no time. But as the global markets are showing larger and larger cracks and signs of a looming massive crisis, worse than 2008 financial crisis, begin to show, remember that this isn't out of the blue. This is not a surprise. After all, we've had people like Jared Bernstein running the show for several years now, and this clip of him is a good one to save for future reference, to remind ourselves who is responsible for the economic bloodbath that's about to come.
The U.S. government can't go bankrupt because we can print our own money.
It obviously begs the question, why exactly are we borrowing in a currency that we print ourselves? I'm waiting for someone to stand up and say, why do we borrow our own currency in the first place?
Like you said, they print the dollar, so why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds. Right, because they sell bonds and people buy the bonds and lend them the money. Yeah, so a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to, yeah, I guess I can't really talk. I don't get it. I don't know what they're talking about. Because it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise, we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing there.
Thank you for joining me today. Please remember to support my channel, give this video a thumbs up, consider sharing it, and subscribe both on Rumble and YouTube. I would love to have you back for my next one tomorrow. Lately, many of you have been saying in the comments section that YouTube keeps unsubscribing you. So please consider following me on Rumble, on Telegram and X, as well as on Substack to stay connected. I'll see you in my new one tomorrow. Take care.